Hello, this advanced financial accounting. Remember, we have to just a quick review. What do I have last time? Advanced financial accounting. Remember again, we have this for cost method and equity method. Remember, we have three examples for cost. First one for cost, second one for cost. After this, we have equity. We have cost and equity, example 3, and example 4 only for equity and worksheet and 100% ownership. There is no minority in this one. Okay, that means this one here. Last time I gave you the worksheet and the example 4. When you have example 4, we will talk about 100% ownership, and I'll show you how to make the worksheet. The same ideas, the same information, and in part 2, you need to go back again in part 2, and example 4. Example 5, the same like example 4, equity with the worksheet, but example 5, we have minority interest. How much is the minority? We're going to discuss it today. How much is minority? How to do with the minority, okay? And I'm going to start with example 5. Example 5, that's the last part of part 3. Remember part 3, cost and equity. Cost and equity. That means example 4 and 5, that's a worksheet. But example 4, 100% ownership. Example 5, we have minority, okay? I go start with the last part in last lecture in the part 3. This one here, example 5, worksheet. I'm going to use worksheet. Minority, we're going to have minority, how much, we're going to discuss it. And we're going to use equity method, okay? Read first example first. On January 1st, 2003, B company acquired 75% of voting stock. When I say voting stock of M-Com, voting means common stock. That's voting stock, common stock of M-Com. That means we have two companies. This one here, B company and M company. For how much? How much is the acquisition cost, investment cost? This one here, 18,000. That's acquisition cost or investment cost. You need to know, you need to go ahead one by one and read and write notes. It will help you. This one similar to example 4, except to have minorities. Okay. This 18,000, is this cash or credit? Cash. Okay. And at the date of acquisition, the book value of M company's net assets were equal. Remember again, the book value of M as a subsidiary of M of net as were equal to fair value. That means book value equal to fair value, except okay, for equipment which has a fair value exceeding. Look at this one, exceeding the book value by 6,000. Okay, and this one here, he said, the remaining life of the equipment, how many years? 9 years. What I'm going to do with this one, I'm going to show you. And he gives you some information. The following were financial statements of B and M, okay, as of December 31st, 2005. Remember, this one, that's 2003. This one, January of 2003. This one, December. That means after 1 year, 12. That's 12 months. If you look at this information, this example is different than example 4. Example 4 is not classified. This one, it's classified. Classified means they give you income statement separate, return the earnings separate, and the balance sheet. Example 4 was mix. All the information mix, and you have to classify it and put it groups. Income statement first, return the earning. At least this example will show you how to do this. This information, December 31st, they gave you sales revenues for company B, 44,000, for company M, 22,000. Income from sub, which is M, 4,000. Put X beside it because we need to know where this number come from. Put X beside 4,000. You need to explain where this number come from, 4,000 in details, remember? And minus cost of goods sold. Cost of goods sold, you have to company B first, 15,000, and the company M, 11,000. Operating expenses, 10,000 minus, and 5,000 for company M. Net income, 23,000 and 6,000. That's the same. This one here, 23 and 6,000. This one, we finish the first one. You need to know what's the element of income statement. That's the element of income statement. Statement of return to earning. This one here, we're beginning return to earning. That's number one for company B and for company M. After that, net income for company B, 23,000 and 6,000 for company. This number come from income statement. If you remember, go back again to income statement. You see this number come from income statement, Safi. That's a net income, okay? 23,000, 6,000. Minus dividends for under company M, they have only 2,000 minus. That means if you look at the numbers here, that means for this one, ending return to earning for company B, 39,000, for company M, 12,000. That's you need to know each one, how to prepare it. If I ask you to prepare it, you need to know the same way, prepare it this way. Okay. The last one, the balance sheet. You know the balance sheet. Assets, liabilities, shareholders' equities. Assets cash, 11 and 3, and AR, 6 and 2, and inventory, 12 and 2. And when I say this company B first and the company M, after this, equipment, investment first, equipment, before equipment, investment in M, investment, put X beside investment in M, 20,500. Put X beside it because this one here, it shows you what this about, okay? Equipment, net of equipment after depreciation, 22,000, and the other assets for this one here, 20,000, and equipment for company B again, 22, company M, 14,000, and other asset, 20,000 and 3,000. That's page 29. We'll talk about the last lecture in this part 3. We didn't finish total assets. Company B and the company M, 91,500. Company M, 24,000. Account payable, 3,000 for company B, 2,000 for company M. Common stock, 49,500 for company B, 10,000 for company M. Return to earning, with this one here, ending return to earning, it comes from statement of return to earning. Look at the number, 39,000. If you look at return to earning, 39,000, and this one, 12,000. Total amount is the same. For company B, 91,500 total assets, 91,500 total liabilities, and shareholders' equity. And the same for company M, total assets, 24,000, and total liabilities and shareholders' equity, 24,000. From this information, I'm going to ask you again the same question as example 4, and same question. We're going to review again this, quick review, and try to do this example many times to understand it. Try to do the worksheet, and try to do example 4. What's the difference between example 4 and example 5? Let's start with the last one, this one here, example 5. I give you question 1. Compute income from sub, 4,000. Where does this come from? You need to show me where this one come from. Second one, compute investment in R, 20,500. Where does this come from? Again, the same questions here. Question 3, prepare consolidation worksheet. We have this before, example 4. Prepare consolidated income statement from the worksheet. Prepare consolidated statement of return to earning from the worksheet, last column in the worksheet, and prepare consolidated balance sheet. That's restated. That's page 30 in example 5. First, I'd like to show you before I show you this one will give you, I give you copy of this. I think Heba will give you a copy. I give her copy, how the copy for this one. If the video is not clear, you're going to see all this number again. This one worksheet it's an empty worksheet. There is no numbers, nothing, just no adjustment. That's only worksheet. It's the same worksheet. I put it here. Same information for company B, company M. It's the same one. And this one here, you need to know, that's page 31, okay? In page 32, you need to know the adjustment. Remember, we have 3 adjustments. I put them here one by one. If you look at number 1, number 2, some adjustment related to income statement, some adjustment related to retained earnings, some related to balance sheet. In general, you need to look at this one, the last column. Very, very important, last column. If you look at your last column, it gives you consolidated cash and income from M, that's nothing, 0, and cost of goods sold and operating expenses. And this one here, something we call minority. Remember, in this example, we have minority. Minority is 1,500. Where is this 1,500 come from? Look at company M, net income 6,000. 25% of 6,000, it gives you 1,500 for minority. I put it here, and I put it here with minus. Look at the number, 23,000. 23,000. What do you call 23,000 in income statement? Consolidated net income. Equal to, look at here, equal to company as a parent, company B, net income. If you look at this two number, 23 consolidated equal to B net income. That's very important under equity method. If you apply equity method, you have to look at the end how much this one here consolidated net income for consolidate equal to parent, which is company B net income. 23. If it's something wrong, go back again and think about it again. We'll finish. Remember again, net income goes to return to earning. Let's start with beginning return to earning, company B, company M. And the net income, it comes from up here. Net income 23, I put it down, and 6,000, I put it down. Dividend under company M, I put 2,000 minus. As a result of this one here, what are you going to see? Look at it again. When you answer, you have to be the example beside you and do it again to understand it. Where does this number come from? If you look at under company B, beginning 16,000, 23,000 come from income statement. That means ending return to earning for company B, 39,000. Okay. For company M, if you look at it, beginning 8,000 plus 6,000 come from income statement minus dividend 2,000 with 12,000. Okay. Now, let's go to the last column is worksheet. Last column. It shows you only company B. Company B, beginning 16,000 and ending, that's one here, 23, that's net income. That's two numbers only. These two numbers, the same, 39, 39. That means this one here, 39,000, and this one here, 39,000. That means ending return to earning of consolidated return to earning equal to company B ending return to earning. That's one consolidated in the at the last column. This one here for company M, company B as a parent. Okay. After this, let's go to the balance sheet. The balance sheet, you have cash, A, B, and M, consolidated cash, 14, AR, consolidated 8, inventory, consolidated 14,000, investment. Look at investment, 0. Why 0? Look at here, 20,500. In front of investment, you go to see two numbers. The first one, 2,500 credit from entry number 1. Second one, 18,000 from entry number 2. This total two numbers, that's 2,500, okay? Just you have to do it one by one. And equipment, if you look at the equipment, you have the equipment for company, this one here, 14, and we have this one here, debit and debit and debit, deduct this one here, it give you 40,000. And other assets will be 23,000. Consolidated assets, 99,000, equal to consolidated liabilities and shareholders, equal 29,000. 5,000. Company B as a parent for 49,500, 39,000. It comes from up there. And minority interest, how I do minority? Again, minority, if you look at here, this one here, minority, we have this one here, that's 2,500, and this one, 3,000, okay? And this one, it gave you, at the end, it gave you minority will be 5,500, that's a minority. Always minority, make it 0. This one is 0, and move it in the last column. We have this in part 2, the balance sheet. Remember, balance sheet with minority is the same ideas, how I do minority, okay? And 5,500. That's we finish. Again, if I ask you to prepare the worksheet, that's a complete worksheet. That's complete worksheet, okay? But if I ask you to prepare consolidated income statement, you need to look at the text from here, okay? Let's continue. Start here. For this one here, compute this one here, that's, if we have this example, if you look at here, to find out, we need to find out where this 4,000 come from. If you remember compute, that's where this 4,000 come from. You need to find the computation, valuation, compute, valuation, differential, and goodwill. Remember this? First, you need to find how much is the acquisition cost, 18,000, minus book value of net assets acquired of company M. How I do this? You need to look at common stock of M, 10,000, beginning, remember again, beginning returned earning at the date of acquisition, beginning 8,000, it give you 18,000, multiply it 75%, give you 13,500. The difference between 18,000, this one and this one, it gave you 4,500. This one, valuation differential, and minus, that's valuation differential, minus revaluation increment for the equipment, 6,000 times 75% give you, that means this example, there is no goodwill, okay? Now, what I'm going to do with 4,500 for the equipment? I'm going to annual depreciation, for not amortization, annual depreciation, because depreciation equipment is a tangible asset. I call it, what happens if I have a goodwill and the equipment? I have one amortization for goodwill and one depreciation for, that means I have two, okay? After this, the annual depreciation of equipment, 4,500 divided by 9 years, it gives you 500 per year. Okay. The last one, it shows you, I like to come to where's 4,000 come from? Share of net income, where it come from? Remember again the question here. Net income, 6,000, multiplied 75%, give you 4,500. Deduct the annual depreciation, the annual depreciation, 500, you know how we get number from, give you, that's the answer. That's the answer, how I do this. I ask you question number 2, compute investment in M in details. Okay, remember we have 3 numbers. Acquisition cost, that's number 1, income from M, number 2, and dividend, number 3. Acquisition cost, it was cash, 18,000. Income from M, 4,000. And dividend, 2,000 times 75% give you 1,500. If you look at this one here, 18 plus 4,000 minus 1,500 give you 20,500. That's balance of investment in M. Okay. Let's go. Remember one by one. Question number 3. Again, just I gave you this to understand again. Question 3 asks you journal entries in B accounting books. Okay. This one here, that's investment in M, credit cash. Second one, investment in M, 4,000. Credit income from M. Remember 3 in 1, 18,000, 4,000, and the first one 18,000. That's entry. Second entry for 4,000, investment in M, income from M. That means you know this. Third one, you need to for depreciation. Remember depreciation. This one here, that's cash. That's cash, 1,500, and that's a dividend. This one here for dividend received. Or this one, 1,500, and investment in M. Okay. We'll get this one here. This one here, the 3 entries. If you look at this, so 3 entries come from the 18,000 acquisition cost, 4,000 that's income from M, 1,500 dividend, 2,075%. That each one will have entries. Okay, remember we have 3 entries. I'm going to ask you again. If I ask you this one here, question 4, T account. When I ask you T account, what you're going to write? T account, debit and credit. In debit side, always put the acquisition cost, and the second one put share of net income from M. Credit 1,500, which is a dividend. Remember again, the number same, 2,500. That means this one here, it shows you T account. T account. But if I ask you compute, look at compute. Question number 2, compute 2,500. The same number, but this one ask you compute calculation. This one here, I ask you question 4. I ask you compute. Yeah, that means this one here T account. That means show me how to do it in general ledger. In general ledger, T account. That's very important. Okay. Now, question 5, he asks you prepare consolidation worksheet. Remember the worksheet again I showed to you? Step 1, you need to compute valuation, differential, and goodwill, if we have. Step 2, enter B company, M company in the worksheet. Just step 3, worksheet adjusting entries. What is it? I'm going to show you. Step 4, minority interest column, 25%. Last column, this one here, the last in the worksheet. Okay. Let me go back again. From step 5, you're going to answer question 6, consolidated income statement. Question 7, consolidated earning. Question 8, consolidated balance sheet. Okay, let's continue. Before I do this, I like to just tell you about how to do the worksheet again. The worksheet will have 3 adjustments. What this 3 adjustment about? What's the reason behind it? I explain all of this to you. Okay. First, you need to eliminate income from sub, which is 4. So eliminate this. Debit income from M, which is sub. Credit dividend to 1,500. The difference between debit and the credit make investment in M. That's a credit 2,500. If you look at the worksheet, you're going to see this one entry number 1, 1, 1, 1, 1, 1, 1. Second, adjust number 2. You're going to debit common stock of M company. Look at M company. That's M company. This one here, that's 100,000. That's 10,000. 7,500. 8,000. 6,000. Okay, and the equipment 6,075. Give you 4,500. Okay, everything here multiplied 75, 75, 75. All of this debit, common stock debit, return the earning, beginning debit, beginning, equipment debit, all of this, and investment ticket. That means if you look at the worksheet, you're going to see this numbers, and you're going to see this number 2. Remember again, we have always have 3 adjustment. An equity method. Third one, operating expenses for depreciation here. Remember depreciation, the 500? We need to do this here for operating 500 operating and equipment 500. Okay. We almost are not finished yet, but almost. Question 6, he asks you, prepare consolidated income statement. Again, you need to go back again to the worksheet, the last column. You have to ready for the worksheet. Even if I didn't ask you, you need to prepare it, and from the worksheet you can answer any question related to consolidation. Okay, any question for this one related to consolidation you can do, it will help you. Okay, now before you answer, you need to know what's the element of income statement. The element start with sales revenues from the last column, 66,000, minus cost of goods sold for two companies, minus 26,000. That's right. And to give you gross income or gross profit, minus operating expenses, 15,500, and at the end, this one here, it give you some mistake in this number, I think, with this number here. At the end, it give you 2,300. We have to correct this one here, that's 24, this one here, you're going to deduct this one. Okay, we have to check this number, net income, before minority. After that minority, it give you 23,000. Okay, answer 7, question 7. Okay, beginning return to earning, 16,000, plus consolidated net income, that's return to earning. This one here, beginning 16,000, which is company B as a parent, consolidated income 23,000, and this one here give you ending would be 39,000. Okay, let's go for balance sheet. The balance sheet for the last column, you're going to take the cash, consolidated cash, 14,000, AR 8,000, and inventory 14,000. All of this consolidated from the last column, and equipment 40,000, and other asset 23,000. Total consolidated assets 99,000. Always total consolidated assets equal to total consolidated liabilities and owners and shareholders equity, or owners equity, or shareholders equity. We'll talk about shares. Look at account payable, 5,000. Here it's going to show you company B only, capital stock, 4,500, ending return 39,000, minority interest in this one for minority 5,500. The total is 99,000. Okay, this one here finish. This one here example. This one finish with part 3. Finish part 3 for cost method and equity method. We finish it, and when we come next time, we're going to start with part 4. Now we finish part 3 for cost and equity. I give you example again. I give you 5 examples. Remember, cost, and the number 3, cost and equity. Example 4 for equity and no minority. Example 5 for worksheet with minority. Review this again. This will finish this part 3. Next time, we're going to start with part 4. I let you know. And the Hiba will let you know. Please, Hiba will be contact with you about if we're going to have exam or research paper, or what do I have to do this 7th week exam. We're going to decide, but we will help you. Okay, we'll take care of this. Thank you, and see you next time when I come to part 4. Okay, when I come to part 4, Hiba will let you know and will send it to you. If you need any question, please send it to Hiba. If you need hard copy of my lecture, I can send it to you. Send it to Hiba, and Hiba send it to you. Also, I do this recording now. Sound here, but no picture. It's okay. I can send this to you too. You can look at it. Okay. Thank you, and have a good day. Bye.